Chapter 3, we talked about the need for payroll and personnel records, and most specifically, we'll get into the Form 941 and preparing that Form 941. So again, we talk about FICA, which we've talked about in our previous chapters, but it's the Federal Insurance Contribution Act for FICA, and those taxes are taken out of both the employee's paycheck and then matched by the employer. So both parties are paying it. So the employee pays the 6.2% and the employer matches it. Then each one also pays the 1.45% into Social Security and Medicare. Then if the wages exceed $200,000, then they will pay an additional amount, just the employee, into Medicare only. So they would only have that 0.9% coming out on their wages exceeding the $200,000, because then they no longer pay into FICA at that point. Self-employment is for individuals who are not employees. So they are self-employed. They are, in a sense, paying the employee and the employer share because they are both of those things. So since they are self-employed, they cover both. So that would be 12.4% for the FICA and then 2.9% for the Medicare taxes. And the same, if they would have that income over 200,000, it's the same deal as if they were employed. So then the issues become, are you an employee or an independent contract? What type of service considers employment? And are those, is your compensation taxable wages? Because you have to pay on those taxable wages. So the next slide, we talk a bit about an independent contractor. So people who are independent contractors are conducting their own independent trade or business. So the key is they have to control their work environment, have to have their own tools, set their prices, set their hours, and then market their services to others. So I know from being involved in a payroll audit that was one of the major things they were looking for, is that you could say, oh no, hey, this person, comes to work when they want, and they use their own laptop or their own, tools or whatever. But then the questions become, are they marketing themselves to others, or are you the only person that they're working for? So if they're marketing themselves to others, or they could market themselves to others, then a lot of times that is what a distinguishing factor, in that payroll audit, then that makes them independent contractors. So then if it is an independent contractor, then that person, the employer, does not have to, I shouldn't call it the employer, but like they call it, the hiring agent doesn't have to pay any of those payroll taxes. So the payroll tax liability is going to fall onto that independent contractor or that self-employed person. If the employer would be employing people, like, so say, it's a taxi company, and really they are working for that company. They're they're driving in taxis that are owned by that company. They're charging the rates that the company tells them to. They're obeying all of the policies and the procedures, and they do not work anyplace else. So say this taxi company says, oh, no, all my drivers are independent contractors, and I'm not going to withhold any taxes. Well, if the IRS would come in and they would go through that payroll audit and say, no, we disagree, they're going to owe, obviously, back all of the taxes that they should have paid and were not withheld. They would also have some penalties for doing that. Now, if the employer, so if the employee, the self-employed person, paid their own taxes, then they would not have to pay their share. But the penalties still could be in place, though, if they were misclassifying, because they need to make sure that they're paying workers' comp and unemployment and some of those other things. So that is going to be part of it. And then the 1099 miscellaneous, we will talk about that, but that is the tax form at the end of the year that the employer sends out to the independent contractors to tell them how much non-employee compensation they had during that year. So then the next question is, what are those taxable wages? So obviously cash we receive, or the, paychecks, so wages and salaries, bonuses, quarterly bonuses, year-end bonuses, if we get paid commissions, if there was any type of meals or lodging that were provided, but not as part of the job. So, maybe you want a trip to Florida or something for your being the best salesperson in the bank or whatever. That would be considered taxable wages. Um, then we have more non-cash type gifts. So, if they are gifts or gift cards over certain dollar amounts, like sometimes businesses will give you a ham at Christmas or, a turkey or Thanksgiving. So those kind of things are not going to fall into that type of compensation. It has to be over a certain dollar amount. If they are paying you in stock, which some publicly traded companies do, that would be an example of non-cash compensation. If they allowed you to have personal use of the assets, like you had a car that you could use, or they have a company jet that you could use, that would be also compensation. And then if they pay premiums on life insurance over 50,000, because a lot of times companies offer that $50,000 life insurance package if it's something above and beyond that. And then obviously vacation pay, and tips if you're a waitress. So then things that are exempt, if like say you are a person who travels for that employer, you're a salesperson, or maybe you work, even like those people who work on the roads. If they are having to travel for their job, then the employer is gonna, sometimes they pay them like a daily stipend, so then they can still go where they want to eat and stay where they want to stay from a hotel standpoint, but there's a certain dollar amount that they give them that would be non-exempt from their compensation. If they get sick pay, so the sick pay isn't like, well, like for instance, I get, like so many sick days a year. That part is taxable to me. If I'm on more of like a long-term disability where it's over 6 months and I'm off, and then it kind of normally that kicks into a whole different type of a payment, like you're no longer paid on your regular paychecks, like a disability plan would kick in. That would be what that sick pay wage is referring to. Then there's the difference between the employee's salary and military pay. So if you have a soldier who works for you and has to, be activated, go into active duty for a certain period of time, employer contribution to retirement plans are not taxable. Employer provided education assistance, so if you're going to go back and get your bachelor's degree and they're paying for it, again, up to a specific dollar amount. And any non-job related expenses. Okay, then we get into what is the base. So this is for 2019. So the tax rate for Social Security is the 6.2% up to $132,900. The Medicare tax is 1.5%. And then there is no base for that. But if on the additional, if you make more than $200,000, then the 0.9% Medicare tax, the employee pays, but the employer does not have to pay. And then this is just a little side note here, that when the Social Security system was set up, way back when, there were 16 workers paying for every one person who was collecting benefits. You can see how obviously, if you've got 16 people working and paying into the system and you're only paying one person out, that system would be building, the savings would be growing, there would be no jeopardy to it. Now it's much less than that, and they're projecting that in 2042 that it'll be 2 to 1. So for every two people that are working and paying into Social Security, one person's going to be paying out. So that's why Social Security is so questionable, because how can they maintain it? It was a great idea back when lifespans were not quite as long as they are now, but people who can retire at 65 and maybe live to be 100, that's a long time to have to pay into it. So there's definitely issues with the Social Security system that you just kind of want to understand. And then if you go into our chapter notes, there's different examples for the computations of it. So please look through those notes and look in the textbook as well. Then we get into our self-employment tax for our independent contractors. So if they have earnings more than $400 a year, they should be getting a 1099. and then they should be paying their own self-employment tax. They will get to write off any business expenses. So like if you are, I'm going to jump down a little bit. If you're just a self-employed person that's doing, so say I'm doing accounting services on the side, I'm going to have a Schedule C. So I would have my accounting services revenues that I probably received a 1099 from whatever business I helped or person I helped, probably business though, if they're sending me a 1099. So I'll record that revenues. I'll write off any expenses I have, maybe business use of my home, paper, ink, stamps, your computer, part of your internet, part of your cell phone. You're going to write any mileage you incur. So you'll write all those things off. So it'll come down to what is your net profit. So it's the net profit that you pay the self-employment tax on. So then at least that's good. You get to write off all your deductions. And again, they're going back up. The self-employment tax is 15.3%, and you pay it on the Schedule SE on your 1040. So you'll do the Schedule C, come up to your net income, then it'll go over to that Schedule C, and you will pay self-employment tax on that net income. You can pay quarterly. Like if you were totally self-employed and that's all you did, then I would highly recommend those people pay quarterly. Or again, you could get fines because you're not paying into the tax system during the year. Okay, so that's kind of the key to that. And again, go to the notes. I have a couple of examples of the kind of it worked out and what ends up on their 1099 and their 1040, and then also read the book. Okay, then we get into our forms. So this form is very important, and I'm going to refer you back to the textbook though, because again, it's better to kind of see the pictures. But it's called a 941, and employers who have employees have to file this quarterly. So it's due by January 31st for the fourth quarter, April 30th for the first quarter, July 31st for the second quarter, and then October 31st for the third quarter. If those dates would fall on a weekend, it'd be the following Monday, the following business day. So that's very common for businesses to file, even if you're a small business or large business. So the textbook goes through that form and shows you pictures of it. I have instructions in the notes, like kind of what goes in line by line, and the textbook also covers that. But you want to be able to prepare one of those. Those are very important to a payroll person. Then also on that 941, you're going to show your deposits. So you'll show your wages and how much taxes were withheld and what the company has as a liability. But then there'll be a section that says, okay, well, what deposits did you make? So if you're a monthly depositor, there's a spot on that form that you just fill in. This is my deposit. This is my liability for month 1, month 2, and month 3. And then you have to pay those taxes that you withheld and that the employer owes on the 15th of the following month. So if you're paying January's payroll, it's due by February 15th. February's payroll would be due by March 15th. If you're a larger employer, then you're going to be paying in semi-weekly. So then it depends on what day of the week your paycheck is. So if it's the first 3 days of the week, it's due Monday. If it is the last 3 days of the week, it will be due on Friday. So first 3 days due on Wednesday, last 3 days due on Friday. Now, if it's really big, so like the oil and gas company I worked for, our payroll was really big, and we had 1 day to pay it. So like if we normally paid it on that day, but if our payroll was Friday, we actually just made that deposit on Friday as well, because you would have till the next business banking day to do it. Same with our 401k withdrawals, we paid those the very next day also. If you're a very small employer, then you don't even have to make those deposits monthly. You could just fill out your 941 and then pay it at the end of the quarter when that 941 is due. And then you'll get notified, like if you get over that $100,000 of payroll, they're going to convert you over into a semi-weekly depositor. So then again, you're depositing the money more frequently than just at the end of every quarter. So how it gets deposited, what they are using is this EFTPS system, which is very easy to use. I actually do a small business. I do their accounting on the side, and we do that. We only have had like one or two employees, so it's not again, it's not a big business. But they encourage everybody to pay it that way. So then you set up an account at that online site, very easy to do. When you're setting it up, you can put in like what we do. It is it's withdrawn directly from the bank account of the company. So you're going to put in your bank account information, your routing number, your account number. Then you go through the steps and tell it, okay, this is how much I'm paying in FICA wages, this is how much I'm paying in Medicare wages, and this is how much income tax was withheld, just federal, because you're not paying the state, you're just paying the federal at this point. And then you submit it and you tell it what day it can come out of your account. So you know what I mean, if your payroll is on Friday and you're going to pay it on Monday, or if it's on if you're that bi-weekly one and you're paying on Friday, you're probably not going to pay till the following Friday. They give you that kind of time, but it's real easy to use that site. If you do not file that 941 or do not pay your tax deposits, then you can be penalized. So you can receive penalizing for not filing the 941, for not paying those taxes when they're due, not making timely deposits. So again, if it's like the next business day and you wait 3 days, if you're not filing because at the end of the year you also file another return with the IRS, and well, it goes on to your W-2s and your W-3. So if you fail to file those, all of those things are going to result in penalties to the company.